Okay.
Hi everyone, just a quick word. We're going to start at 5 past, so if you want to go and make a quick cup of coffee before we start, now's the time. Otherwise we're going to launch in straight here. I've also got mine. Don't know if you can see it. And it's not laced, I promise you. And we'll start at 5 past, so stand by.
If any of you guys have any specific topics that you need me to find the presenters on, feel free to leave a message in the chat, and I'll see what I find. Just want to double check everyone was hearing correctly. I got someone message me saying that the sound is a bit comes and goes. Just want to everyone just raise their hand that they can hear, or message if you're having problems to hear. I am seeing a lot of people put their hand up in the chat, so I'm assuming it's working now. And yeah, we're better now. All right.
Okay, so it's 5 past. So welcome everyone. Welcome Milan, following on from yesterday. I hope you had a good night's rest and fresh to go. And so no need for a further introduction, but Milan, the floor is yours.
Thank you, Stan. And yeah, I had a night's rest, but not as great. But I had some rest at least. Now, boy was up last night, so didn't have the full night rest I wanted, but it was all good. I'm ready to go. So I'm gonna just quickly find my slides and I'm gonna share it. All right, like yesterday, I don't, obviously when I'm using Zoom, I can see myself here in a corner. I don't like seeing myself when I'm presenting, so I'm just gonna stop my video and then start the presentation. Right. So welcome to the Ifrs update for 2022. So, this particular update is a bit different from previous ones. I think if you have attended the Ifrs update before, usually they go through all the Ifrs changes, which we will, but there's a big component that we're going to focus on today, which is climate change and sustainability. There's a lot of movement happening in the last 12 months on sustainability reporting and specifically climate related issues. So yeah, I hope you guys will enjoy this session, and if you have any questions, please feel free to ask. I'm not the full expert. I think everybody's learning as we go along. But if there's some questions that I need to go and research on and find out, then I'll definitely do that for you. But as it stands now, it's very interesting, and there's still a lot of stuff that needs to happen on sustainability as well. All right. Sorry, but I just jumped in now, but just to refresh again. So I'm Milan van Wyk, a chartered accountant. I'm a senior lecturer in accounting at University of Johannesburg, and I've been doing this for a couple of years, and Ifrs Updates, and now more specifically, I'm moving towards sustainability reporting and integrated reporting. And that's why today is very exciting for me as well. So let's get cracking. So just a professional opinion and disclaimer and copyright. You guys can just go through your slides. Just make sure that you don't do what you shouldn't be doing. Anyway, all right. So I'm going to start off just by talking about some IFRS changes over the last 3 years. Some of them will be more you will be familiar with. Others might be a nice refresher for you. But we're going to go and have a look at these changes in due course. All right. So I'm going to start off with IAS 8, accounting policies and changes in accounting estimates and errors. So I just want to quickly annotate here so everybody can just follow where I'm indicating. All right. So a couple of things that changed. So the definition of accounting estimate has changed, not significantly, but there is some changes there. Then very important then in terms of measurement uncertainty. You need to, if you have a monetary item, a receivable or a loan or anything like that, and there's any measurement uncertainty there, you need to make specific mention to the judgments and assumptions when estimating that monetary amount. Okay, and it also links nicely with fair value disclosures on IFRS 13. You need to go and make mention of those assumptions. Okay, and it can actually leverage from the two, I think, as well. All right, and that's paragraph 32. Then regarding the estimates, so you need to include, if you have estimates, you need to include measurement techniques and changes to the input. So again, sorry, it's important to show that information of the changes and the possible sensitivities to your users of the financial statement, so they can understand how your estimates are made and what uncertainties you might be exposed and how sensitive you are to those sensitivities and outcomes. All right, and I think this topic is a very important topic. Estimates, judgments. We'll see now also when we talk about sustainability and climate change how important that would be. And then also just a general principle is that it is an accounting estimate, all right, unless it's a correction of an error. Okay, that's just a clarification that they brought in there in terms of paragraph 34A. Okay. All right, and that's it on IAS 8. So if we move over to IFRS 16 leases, so there was a lot of stuff happening during COVID specifically. Obviously, leases standard was issued, and then COVID came, and there was a lot of stuff happening during COVID. Many of you are exposed to it, or were exposed to it. And the biggest thing that happened during COVID, there was a lot of rent concessions, and what happened there was the ISB took a decision to provide guidance on rent concessions. And basically, normally a rent concession would constitute a modification, but the ISB said, like, because of COVID-19, we need to have a practical expedient on that. And basically, the practical expedient talks about the modification or the rent concession not being treated as a modification. So it's a simplified way of doing it. And you can look it up in paragraphs 46A and 46B. And basically what it comes down to is that you still remeasure your lease. So you recalculate your lease liability and your right of use asset and make an adjustment, but you don't need to go and calculate a new a new rate implicit to the lease or discount rate. You can use the original discount rate to do that. Okay, so that's one of the biggest parts of the practical expedient. Okay, then very important also is that there are basically three approaches. So I looked at what EY has provided in terms of guidance. So there are basically three ways of doing it. So the first one is that you treat the concession as a form of forgiveness and treat it as a negative variable lease payment. All right. So what basically happens is that you take the adjustment to the lease liability and take it to P&L. Okay. And we'll call that approach one. Then the second one would be a similar one, but this time it's still a variable lease payment that you fix from previous lease payments. And in this case, then you will make the adjustments against the lease liability and the right of use asset. Okay. Then the third interpretation is that you account for the concession as a deferral and as if the lease is unchanged. Okay. So effectively, there's no changes. So this is most likely the best practical expedient that you can provide, because then you don't change your amortization schedule. You just account for it as it would have been done if there aren't any material changes or changes of substance. Okay. And important here is the effective date. This has changed because the original one was already issued in 2020. This one is an updated one for 2021. And yeah, so the effective date is 1 April 2021. So if you have a financial reporting period that has a 31, well, after that, if your year end started on 1 of April or later, you would be able to apply this practical expedient. Okay, if you meet the criteria. So we'll quickly talk about the qualifying criteria. So the first one would be, if you go there, the first bullet point is that it needs to be a direct consequence of COVID-19. So it can't be anything other than COVID-19. You need to be able to apply, this exemption or practical expedient based on the COVID-19 implications. Okay. Then, in terms of the consideration, it needs to be substantially the same or less than the consideration immediately preceding the change. So it can't be more. So it can't be the opposite, saying that there will be more lease payments or extension, but there will the consideration that you receive or pay will now be more than previously. Okay, so it needs to be the same or less than the consideration immediately preceding the change. Then the third one is that the reduction in lease payments need to be originally due or on or before June 2022. Okay, so that's just the payment that is relating to. And then lastly, there shouldn't be any substantive change to the other terms and conditions. So it should actually just be leasing the same asset, and it's just a concession in terms of the lease payment, and there's no changes in how you would use it, a change in scope or anything like that. Right. Okay, so let's have a quick look at an example. So here we've got Restaurant Y that leases a space in a shopping mall from lessor Z. Under the terms of the lease, Restaurant Y makes a fixed lease payment, makes fixed lease payments to the lessor Z for 600 currency units. And the payments are made semi-annually in arrears. And the non-cancelable lease term starts on 1 January 2020. Okay, and it ends on 30 June 2021. So they're basically three payments, 600 in June 2020, 31 December 2020, and then 30 June 2021. Okay. The contract does not include any lease, non-lease components or extension or termination or purchase options. The discount rate is 5% at the commencement date, and obviously that hasn't been revised because we're using the practical expedient. And as a direct consequence of COVID-19, the pandemic, on 1 July 2020, the lessor Z agrees to defer the lease payments originally due on 31 December 2020 to 30 June 2021. So basically what happens is that the payment that was due on 2020 forms part of the payment, it gets added to the payment on 30 June 2021. Okay, so it's not like everything just moves on 1 month, one payment period. It basically means that there's nothing in December, and then 1,200 currency units being paid on 30 June 2021. Okay. Then they say specifically there are no other changes to the terms and conditions on the lease. And let's have a look at the journal entries. Okay. So let's quickly just talk about, before we go to the journal entries, maybe go back. So does it meet the criteria to apply the practical expedient? Okay. So firstly, it's a direct consequence of COVID-19. So yes, the first criteria is met. Then also, is there any changes, or is the consideration substantially the same or less? Yes, it's still substantially the same, because just differs from the middle payment of 31 December 2020 moves to 30 June 2021. So the payments are still 1,200 subsequent to the decision being made. Okay. There are no other changes to the terms and conditions. Okay. And therefore, you will be able to apply the expedient. Okay. So if you go then and look at the options or the approaches. So again, you guys don't have this on your slides, but you can just quickly draw yourself like a little timeline. I just did it for myself when I prepared beforehand. So basically, you can just draw yourself a timeline and what happens with the payments. So if I could just quickly just indicate here. I'm just going to move to the drawing tool here. So obviously the decision has been made just after the first payment has been made. Okay. So obviously what is left was your 600 for 31 December and then 600 for 30 June. Okay. And what basically happened is that with the change, there is no payment for 31 December 2020 in that year. All right. And that payment actually moves over and gets added to the 30 June 2021. Okay. So basically now what happens is that you need to go and recalculate your lease liability at the point where you made this decision and when the concession has been adopted. So in terms of calculating that, is that you need to go and calculate the present value before the rent concession and also afterwards. Okay. And then the difference will be your adjustment that's being made. Okay, so you take the fair value of the lease payments, or not the fair value, the present value of the lease payments, you discount the payments with 5%. And again, it's the original discount rate because you're using the practical expedient. And if you calculate, you'll get for beforehand, you will get the 1,157. And after the rent concession is applied, it is a 1,143. Okay, so you can see there's a reduction of 14 Rand between the two. Okay, so what is now important is that there's a reduction. So obviously, the lease liability, you can see in approach 1, the lease liability gets debited because there's a reduction in the lease. Okay, we'll talk now about approach 3, but approach 1, basically because you're treating it as a negative variable lease payment, variable lease payment, you will go then and adjust the corresponding entry on the credit side to profit and loss. So it goes directly to P&L with the change that you've made. Okay. Then on approach 2, the only difference on approach 2 is now because you're fixing a previous variable lease payment, you are incorporating it as part of your original terms, and therefore the adjustment is made to the right of use asset. Okay. And then the final one is that, where you treat the lease as if nothing has changed. Okay. And in that case, what basically happens is that there's no change to the amortization table. Okay. So you don't charge interest during the rent-free or the deferral period, but you catch up that amortization when you make the payment at the end. Okay. So when you make that 1,200 on 30 June, you make up the outstanding amount. Okay. All right, and that's basically it for leases. All right, so I'm just going to quickly just clear all the drawings here. There we go. I'll move over to Spotlight. All right, so if you have any questions on that, please let me know. All right, moving over to IS1. And the effective date for this update is basically the 1st of January 2022. So if you're a 31 December 2022 reporter, then this will already be applicable to you. So the big thing is that they've introduced an additional paragraph, 72A, which basically talks about the classification between current and non-current liabilities. And if you have a right to defer a payment for longer than 12 months, that right needs to exist at year end. So it can't be something that happens, after year end, but before you issue the financial statements. It needs to exist at year end. And again, you can talk about IAS 10, the post balance sheet event, and specifically that condition doesn't exist at year end. Therefore, it's a non-adjusting event, and therefore, they just make it very pertinent that if you had make any changes to the structure of the loans, that if that condition didn't exist at year end, that you wouldn't incorporate for that set of financials. All right, and we'll have a quick look at an example here. So company A has a December 2021 year end. On the 15th January 2022, company A decided to restructure a loan to extend the capital payoff period with 12 months. Okay. And what that meant is that the loan is not repayable on 31 December 2022, but rather 2023. Okay, so basically what happens here is on 15 January, you extend it with another year, which means that on 15 January, it moves from current to non-current. Okay, but the question is on 31 December 2021, which is the year end, that condition on 15 January did not exist. Okay, and therefore you still classify it as a current liability. Okay, even though there was no intention or change made, even though there was an intention possibly, and a change was made after year end. Okay, but the condition didn't exist at year end, and in terms of paragraph 72A, you won't be able to make that classification change. Okay, all right. Then if we move over to business combinations, so here we're sitting with contingent liabilities, and again, just to say that they just reiterate that if you have a present obligation and an outflow is not probable, you still have a contingent liability. But now what they've done is they also aligned it with the definition of the framework. Okay, so paragraph 31A, B, and C just reiterates that principle that if you have a present obligation and you don't have probability or high probability that the cash will come in or flow out, you still need to go and recognize it at the fair value if it is fairly determinable. Okay, and again, just reiterating again that paragraph 23A, that contingent assets will not be recognized in a business combination. Okay, because a contingent asset doesn't have control, so you can't recognize it. Doesn't meet the definition of an asset. Then again, the effective date is 1 January 2022. So if you're the 31 December 2022 reporter, then you will already apply this. IAS 16, property, plant, and equipment. So a change that they've added paragraph 20A, and they basically said if you are testing a particular PPE item like a machine, and you make revenue and cost of sales from these test runs, you do not recognize as part of the PPE, all right? And you will basically just take it straight to P&L and not against PPE. Okay. And again, this is an effective date of 1 January 2022, so it's effective for people that are reporting on 31 December 2022 onwards. Okay, so just a quick example again, the company X manufactured a machine that will be used in providing services to customers. The machine was manufactured for 1 million Rand. In testing the machine before intended use, revenue of 100,000 Rand was earned with a corresponding cost of 80,000. So basically what happens here is it's still treated, recognized as 1 million Rand, all right? And the 100,000 revenue and the 80,000 cost of sales is recognized in P&L. Right. Moving on to IAS 37. So IAS 37, just a clarification on onerous contracts. So they say the cost that directly relates to the contract needs to be part of the cost of the onerous contract, okay? And that would include cost to fulfill the contract, okay? And then they've provided some examples of what that would be. And they basically explained that the cost to fulfill includes incremental costs. So any direct material, labor, and also allocated other costs. Okay, so as long as it's incremental cost. And that's in paragraph 68A. All right, and again, effective date is 1 January 2022. So if you're a 31 December reporter, you would report on this. Then IAS 12, income taxes. So you should know that there is a deferred tax exemption upon initial recognition in terms of paragraph 15 and paragraph 24 of IS 12. What basically means that you cannot recognize deferred tax at initial recognition because there's no implication on the income statement for accounting or tax purposes. And in this case, if you have a situation where asset and liability is recognized at the same time, such as leases, right of use asset and lease liability, that exemption does not apply. Okay. And what it basically means, if you go and explain it, so if you have a lease agreement, for instance, with a company to lease a manufacturing plant for 5 years, the lease liability was determined to be 2.2 million and the right of use asset 2.5 million. What will be the deferred tax? Okay, so what will happen, if you treat them individually, the carrying amount is 2.5 for the right of use asset, and there's no deductions against that, and therefore there's nothing on the tax base side. Lease liability, it's 2.2 million. The liability, the tax base will be 0 because the lease payments will be deductible in the future. And if you look at them individually, on the first date, nothing happens per se, and therefore they will be exempt. But in the case where you look at these two together as a single transaction, then you will not be applying that exemption. Okay, so in this case, your carrying amount of your right of use almost gets offset against the lease liability and the tax treatment of that, which will result in, if you look at the right of use asset, you have a deferred tax liability of 700,000 Rand. And also for the lease liability, if you work out what the deferred tax would be, it will result in a deferred tax asset of 616,000 based on this exemption or exception of the exemption rule. Okay, right. So the net effect there would then be 84,000 deferred tax liability, but obviously, you present them separately in terms of IS 12. Okay, that brings it into the Ifrs updates. So not a lot happening. There's not a lot of changes being made in recent years, except for COVID-19 implications. But a lot of stuff happened in terms of sustainability reporting. So the next hour or so will definitely be focusing on sustainability more. What I will do is I will I'll go through the climate change impacts on Ifrs first, and if we're done with that, then we might take a 5-minute break quickly, just a comfort break to have another shot of espresso or something stronger if you like. I know Ifrs is sometimes tough to handle. So after that, then we can continue, and we should be done by 3:30 at the latest, I think. Right, so sustainability and the impact of climate change on Ifrs. So this is different to the one that we'll speak about a bit later. But in the recent year and a half, climate change has been a hot topic for many organizations globally. And climate change has impacted many business models and actually has a financial impact for many companies, but not all companies necessarily. And maybe to a lesser extent if you depending on where you are. But if you're in mining or construction, you are quite in the middle of climate change, and in agricultural companies also, the impact of climate change is massive to them. And you do have an impact on your business model and an impact financially and on your financial statements if you think closely and think deeply about it. Okay. And it has been a massive focus point for the United Nations. The COP26 conference also, they've made certain mandates and certain sustainability agenda points that needs to be implemented and focused on, and we'll talk about that a bit later. And also the World Economic Forum, they are focusing it as one of the most significant risks that society faces globally, and it's a hot topic and a prioritized topic for these entities. And globally, I think South Africa might be a bit behind in this in a certain way in terms of regulation and social issues that we have in South Africa. But it's definitely something that needs to be addressed going forward, and that's my personal opinion. But I'm not here to extend my personal opinion. So anyway, but so in terms of IFRS, the impact there. So there isn't a specific standard that talks about climate change and the impact on IFRS in terms of climate change. Okay, but what you need to consider, you need to go and consider it if it's material. Okay, and we'll talk about that on the next couple of slides. So you need to go and consider it. So it is a topic that maybe from a South African context it might be premature, or it might be something that is in its infant stages, but it's definitely something that is going to become a big deal in a short, in a medium to long term, most probably. Okay, and because the JSE is starting to focus on it, so if you're a listed company, you'll see the JSE will be issuing reports on that. They've got a guidance document on climate change impact on IFRS. So there's a lot of movement and activity regarding climate change and sustainability for the JSE as well. Right, but let's do a quick poll. So Danny, if you can run this poll for me. So my question to you is, how do you think climate change impacts your financial statements? And there are a couple of options there. I haven't thought about it. You think it's not material. From a risk management point of view, it's something that will impact impairments of assets, recognition of liabilities, and revenue recognition. So I'm going to give you a minute to quickly, think about it and apply your mind to it, and then we'll have a discussion. All right, Danny, I'm not sure how far they are and how the votes are coming in. You can count.
We've got about 60% voted so far. Waiting to give it another. Okay, a few more people now quickly answered. Let's give it another 5 seconds, and then I'll close it off. All right, I'm closing that poll now.
All right, wonderful. So people have voted. Votes are in. Very interesting. Not a lot of people say revenue recognition is impacted. So we'll talk about that when we go through the topics. But 70% said, I haven't thought about it yet. 13% saying it's not material. And a lot of people talk about risk management. Yeah. So, your financial instruments, your liquidity, all of that gets impacted. So definitely a big area. Impairment of assets for sure. Recognition of possible new liabilities. If there's new regulations and stuff coming through, definitely something to consider in your financial statement. So thank you for the votes. So I'm going to quickly move on to the next slide, and we'll talk about the detail now. All right. So let's quickly just talk about IAS 1. So IAS 1 basically provides guidance in terms of presentation of financial statements, and it provides overarching implications at the end of the day. So, so what the IAS 1 basically talks about in paragraph 112, it talks about the disclosure of information that's not specifically required by IFRS, the IFRS standards. So if there is information that would be useful to users, and the IFRS standards does not specifically require them. You are required to then go and disclose that information, okay, if it is material, okay. So that's important. So if it's not material, obviously you can exclude it, but I think it's becoming more and more important to show that judgment of, you know, possible implications from climate change on your business, and, you know, how it influence your presentation on the financial statements. Right, then also very important, if you look together with paragraph 31 of IS 1, you know, if there's emission of material information, it could be regarded as a non-compliance with IFRS. Okay, so if there's material information that's important to reporting purposes, you need to go and disclose it. Okay, and like I said, so additional disclosures then may be needed to provide useful information that is relevant and faithfully represented in the financial statements. All right, and there's a very important consideration to make is the consideration of materiality. So there's a lot of talks about, you know, having two sets of materiality, one for the financial statements, but also then from outside, from external point of view, looking at the financial statements, what will be material from external point of view. So they call it the double materiality. But there's also concepts they're talking about now with the new ISB, the ISSB standards that talk about dynamic materiality, which means it's a well, exactly what it means. It's a dynamic number, and it's always changing, constantly changing, that you need to reassess it regularly to be able to update that. All right, but let's talk about possible climate change impacts. Okay, so I've listed a couple of standards here. It's not an exhaustive list, but this comes from the ISB and documents that they have issued or published, which is not, you know, authoritative, so it's not like a standard, but it's guidance documents that they have published. And the first one there is IS 1. So we've spoken about the overarching implications, but there's also some specific stuff. So firstly, the sources of estimation, uncertainty, and significant judgment. So again, you know, we live in an uncertain environment, a lot of uncertainties regarding climate change, you know, how it impacts your business. You know, if you're a farmer, you know, and there might be severe rain patterns or droughts, how does that impact your farming businesses? Or, you know, the water temperatures that might change, you know, how does it change fisheries, for instance? You know, you know, some mines, for instance, they didn't really get, you know, actually somewhere in the Northern Cape, and they don't usually get rain, but in recent years they start getting a lot of rain, especially in 2022. If you think about the summer, how much rain we've got. Some mines actually lost production because of the amount of rain that fell. And you know, we can't, you know, it's maybe premature to say that's the, you know, climate change is the reason for that, but it's something to consider. And you know, maybe do some research globally about what the implications are. Same thing what happened now in KwaZulu-Natal, you know, all those floods, the damages that has been caused, the disruption in production and supply chain, all of that, you know, again, questions have been asked, you know, is this climate change aftermath, or, you know, is it just, you know, maybe El Nino or whatever? But anyway, there is some stuff that you need to go and think about. But again, the sources of estimation uncertainty is important, because when you're estimating useful lives of assets, or you know, calculating expected credit losses, or revaluing certain assets and liability, or not liabilities, certain assets, there are certain climate change matters that might influence your financial statements. And again, showing that you understand those uncertainties and what the influence could be on that, what climate change might have on it, and that you need to go and explain that uncertainty and the understanding of that implications on your future cash flows. Okay, so that's the first one. And also judgment. So, you know, if you, let's say you've got a deferred tax asset, and we'll talk about that a bit later, but and you don't have if you're not certain that you'll have profits because of climate change implications, then it might be something that you need to go and say, you know, this is why I have recognized that I have considered climate change implications on our business, and we still believe it's profitable, for instance. But you know, it's something to think about. Added to that, also the going concern implications. So you know, if climate change is significant to your business, you know, the paragraph 25 talks about, you know, you need to go and disclose material uncertainties that cast doubt on your ability to continue as a going concern. So if you are very exposed to climate change matters, and it's actually a significant threat to your business, you need to go and disclose those uncertainties. All right. So, you know, again, you know, I can't make a blanket statement and say, yes, it is material. You need to go and assess it on your company and your organization. Right. Then from an IS2 perspective, so inventory. So what can happen is that some inventory items might be obsolete. You know, there's no market for it because of climate change. So if there are regulations globally, let's say in the United, what do you call it? The European Union, for instance, they're quite big on climate change and reducing emissions and stuff like that. So there might be certain regulatory implications for inventory, and then if you're an exporter, suddenly you can't export those inventory items because of these regulations coming in, and that might impact your obsolescence, or well, it will make your inventory possibly obsolete, and that you need to go and write that off. You know, in terms of obsolete inventory items. Right. Same thing can happen with inventory items in the sense that, you know, to reduce the greenhouse gas emissions or CO2 emissions, you need to change your supply chain, get new suppliers in that might cost more money. And again, you know, the item that you're selling, if you can't recoup that value, you could end up in a situation where your cost exceeds your selling price and your net realizable value, and therefore need to have other adjustments to your net realizable value. Right. Then I've spoken about IS12. So again, recognition of deferred tax. So if there's an uncertainty about profitability or future tax credits that you can use, again, those judgments need to be applied on your organization. Right. Then in terms of IS38 and IS16, so with the threat of climate change, there's also opportunities. So with research, so again, you can as an organization start doing research on certain software or products or technologies that can actually combat climate change, or how to measure certain CO2 emissions, or how to reduce CO2 emissions. And all the research you've done in maybe developing something new, there might be implication in terms of IS38, you know, whether or not the research cost will then be expensed, or whether or not there's development cost that you can actually capitalize in terms of IS38. Right. And obviously that can filter through to IS16 when you actually have the machine developed and you have cost in terms of IS16. You know, what can you capitalize, what should you expense, etc. Then added to IS38, so if you have new products, new technologies coming in, you know, it could be a situation where your old technologies, your old assets, machines, plants could be you know, old and obsolete, and therefore there could be an indicator. It will be an indicator that impairment might exist, and then you need to go and impair those assets that you won't be able to use, and that's not relevant in the current environment anymore. All right. Same thing for lines of businesses. If you've got a business that is really onerous for the environment, and again, there might be some regulatory implications or sanctions or anything like that coming through, then, you know, the impact of the environment or the climate change impact will result in impairment on the goodwill on that business, for instance. So there are some elements that you definitely need to consider, but again, it's all about assessing that for your company. And again, it might be premature for South Africa, but it is important to consider. Then IS37, so if you have maybe new recognition of new liabilities or changes in measurement. So again, there might be some new levies that are being charged by governments that, you know, if you have exceeded certain number of CO2 emissions, there might be some some additional levies charged against you and additional taxes, regulatory changes, certain things that you can't do anymore, and then you need to go and restructure a certain company or certain business line. There could be onerous contracts that exist. Again, you might have a product line, you might have a contract with someone, or renting a plant or a facility, and the product line is obsolete due to climate change, and then you're sitting with an onerous contract. Okay. Ifrs 7, pretty much about risk management. So how liquidity risk is managed, how market risk is managed, interest rate, all of that. And again, if you think about climate change, it could impact, for instance, your credit risk of companies, your customers. So you might not be directly impacted, but maybe one of your customers are. And it impacts their business significantly, and obviously then indirectly impacts the credit risk that you are exposed to, because that other organization, the customer, won't be able to repay their outstanding debt, and it could result in a default on your debit book. All right. Then in terms of IFRS 9, so there, very interesting is that the financial instrument classifications can change. For instance, you might have, and this might be more applicable for insurance or banking companies, but if you have a financial instrument that also is linked to certain climate change targets, CO2 emissions, etc., what can happen? And the thing is that you can suddenly you thought you would be sitting with the amortized cost financial asset, but then with that clause coming in, it could change to something different, like a fair value through profit and loss, because there's another element. There's almost like a embedded derivative in that transaction. Okay. Then in terms of expected credit loss, I touched on it on IFRS 7, but again, there could be implication on expected credit losses for your entity as well. IFRS 13, so again, fair value measurement. So again, if climate change has impacted the value of, let's say, investment properties, so let's say you want to reduce CO2 emissions, or again, the building that you are leasing out doesn't meet certain criteria, and you need to incur certain costs, or it will, if you don't do it, it would impact the value of the property or the leasing ability of that property. Again, those type of assumptions and forecast needs to be taken into account with your level 3 fair value measurement calculations and disclosures. And then lastly, IFRS 15. So if you talk about revenue recognition, there could be an implication, and especially I'm thinking about construction companies. If you think about what happened now with some of the companies there at the Natal coast, where the production has been impacted significantly. Construction couldn't happen now for a number of weeks, maybe months, being delayed. And again, that could trigger performance targets not being met, or penalties being incurred on a particular contract if you're construction, or if you've got a supply contract with another customer, with a customer, and again, there might be clauses if you don't meet that, there might be additional penalties or additional modification that needs to happen on those contracts. And again, that would have then an implication on your contract and revenue recognition, and therefore you need to go and adjust for that. So again, just going on, the implications here, and like I said at the start, it might be premature for South Africa, but the JSE already is on the, if you're a listed company or a reporter on the JSE, they already have a focus and on this particular these particular issues, and going forward, it might develop into something quite significant in the medium to long term. Okay, good, and that's it for the first part. I'm going to take a break for 5 minutes now, and everyone can just have like I said, a nice shot of espresso or something stronger if you want, maybe an orange juice or so, and we'll be back at 5 to 3, and then I'll just cover the last bit. So, and again, if you have any questions, I haven't had any questions yet, so I'm a bit concerned or scared. that they're not, yeah, that it's not interesting enough. But yeah, if you have any questions, please feel free to ask me. Thank you. Okay, welcome back, everybody. I think I'm going to start again. So I have two questions here in the Q&A. The first one, just to explain the difference between IAS and IFRS. So yeah, it might be covered now in the slides coming up indirectly. But IAS and IFRS, it's standards that has been issued by the ISB, but it all depends on the year it came into effect. So the IFRS standards are usually the more recent standards that has been reworked and reissued. Okay, so that's the ones that has been basically started from scratch. Whereas the IAS standards are ones that are adopted historically from other GARP requirements like the African GARP, UK GARP, etc. So that has been reworked a little bit and just talked about international accounting standards. All right. So, but the IFRS standards are the ones that have been reworked from scratch and issued, you know, in the early 2000s to recent years. All right. So it started obviously with IFRS 1, and we're already sitting at the IFRS 17 now. Okay. Good. That was a nice question. So, and then Anthony is asking, as regards the general requirement regarding the disclosure of material circumstances, would the example of a fried chicken company be required to assess and disclose the impact of the shortage of the cooking oil brought about by the Ukraine war? So, I think it might be a sustainability issue, not necessarily like a climate change issue, but it's definitely a sustainability issue. So if cooking oil is a key component in your business and what you use, and it might change the how you price your products and how you would generate revenue, and it could have an implication on your customer and the sensitivity of, you know, who will actually buy this, you know, and how sensitive customers are towards price changes on cooking oil, for instance, then that would be definitely something that I would disclose. It is material to your business. I think it will definitely be something that you need to go and consider. All right. So, and again, you know, climate change is a component of sustainability. So when we talk about the sustainability standards now, there might be broader considerations that you need to make beyond climate change, which the Ukraine war is one element. It might be short-lived, it might be here for a couple of years to come, but it's definitely something to consider. Okay, good question. Thanks, Anthony. All right, so okay, yeah. So here, Jaap is asking, what is a TCFD and the IRC and SASB? So we'll talk about that just now. Thank you, Jaap. All right, so we're going over to sustainability. So, I'm just going to give a quick overview of sustainability standards. So we've got the Value Reporting Foundation that historically, you know, a couple of years ago, they were responsible for the integrated reporting framework. So value reporting was integrated reporting before, and a lot of changes happened in the last year or two. So initially, the IRC with the integrated reporting framework was alone, all right? And then I think it was in 2021, they consolidated with the SASB standards. So they actually consolidated together and they formed the Value Reporting Foundation. Okay, so that's basically integrated reporting, the SASB standards, and integrated thinking principles. Okay, then what we also have globally is a Climate Disclosure Standards Board. All right, so they give some detailed disclosures on environmental impacts and water usage, etc. So I'm not an expert on that, but I know, you know, they're also quite specific in what they want to disclose. And then you've got the GRI standards that has a lot of industry-specific disclosure that you need to make for sustainability, etc. Then then you've got a task force for climate change related disclosures, financial disclosures, and that's a US-based organization. So they call them the TCFD. And they have issued prototypes, you know, in recent years where they provide you guidance on what to go and disclose for sustainability reporting, and specifically on climate-related matters. Okay, so all of that happened, you know, in last, you know, let's take it 24 months since COVID started. So a lot of stuff happened, and you would see a lot of companies actually have adopted the TCFD recommendations. A lot of our mining companies, possibly because they've got international exposure, but a lot of mining companies already adopting or looking to adopt the TCFD recommendations. And basically, if you talk from an IFRS point of view, okay, so we've got the IFRS Foundation at the top. So they basically are responsible for two elements now. Okay, so originally, they had the ISB, the International Accounting Standards Board, and they were responsible for the IFRS accounting standards. So IFRS and ISB standards, IFRIX, the SIC standards, all of that. So all the accounting, the normal accounting standards were on this left-hand side. Okay. But now what happened is that the IFRS Foundation also formed an International Sustainability Standards Board. Okay, so this is the new thing now. So there's a Sustainability Standards Board that is managed by the IFRS Foundation. Okay, and they will be responsible for development of sustainability standards. Okay, and as part of the ISSB, so in the ISSB, then they actually consolidated, the Value Reporting Foundation, which basically incorporates the Integrated Reporting Framework, the SASB standards, and Integrated Thinking Principles. And they also consolidated in the Climate Disclosure Standards Board. So all of these organizations now fall into this ISSB. All right. So, and just to give some context here, so this was basically to ensure that there's a bit more of a holistic and convergent approach to sustainability, because the problem with sustainability in the past was there are so many different ways, different frameworks and standards to comply with, and it really didn't provide enough comparability and measurement of performance and KPIs in terms of sustainability and climate change, for instance, and therefore they move towards issuing a single framework or a single board where they can have sustainability standards internationally applied. Good. So the formation of the ISSB. Okay, so in September 2020, they started to talk about it, and they started to say, okay, we need something to give global combined sustainability standards. And in March 2021, basically they established a working group to work on a prototype to issue as a standard. Okay, then basically in November 2021, and that's where the UN Climate Change Conference, the COP26, they decided, the IFRS Foundation decided to create an International Sustainability Standards Board. Okay, and that will then be the standard setting board within the IFRS Foundation, and they will then be tasked to create or issue a standard specifically on sustainability. Then what happened in March 2022, just the other day? So they published 2 exposure drafts for consultation. So we're in a consultation period now up until July, where people can comment on this new set of sustainability standards. All right, that will hopefully, they say that they want to issue it by the end of the year, and then it will be voluntary effective immediately, but there will be a effective date possibly later on, maybe 2024, 25, I don't know. But there's definitely something new that will be issued for sustainability in the next couple of years to come. All right. Then if we move over to the exposure drafts that has been issued. Okay, so there are 2 separate standards. So there's one that focuses on the general sustainability issues, and there's one specifically focusing on climate change, because the UN and the World Economic Forum lobbied for this. They say this is a critical thing for society, and that's what they want to focus on. And basically, the drafts, like I mentioned, are open for comments up until July 2022, and will be issued by the end of the year. And like I said, so there's, on the one side, you've got the general disclosures, and then you also have climate-related disclosures that you need to have a look at. So if you look at the first one, so the general sustainability standard. So the key focus here is that they focus on enterprise value, which is your equity plus your net debt, and also to focus on the reflection, to focus on expected future cash flows in the short, medium, and long term. And that's something that comes from the Value Reporting Foundation. to look at the cash flows and see in the short term, medium and long term, what will the impact be on your enterprise value. And important about the sustainability, it's broader than the financial statements. You focus on the people, planet and economy. And you need to show important information regarding the risk and opportunities regarding sustainability and also the judgments involved with that. Okay. Then important is that the report on the sustainability will be what can I say? It will work continuously together in the same time frame as normal financial statements. So when you issue the financial statements, you also will issue a sustainability report depending on the jurisdiction and whether they are adopted or not. Okay, so at this stage it still will be voluntary, but it could be a situation where the Companies Act would require you to issue something like this, or the JSE or whatever. But there will be, it will be based on jurisdiction and how it will be regulated. Then the specific standard will also then be basically, if you think about normal IFRS, it will be equivalent of an IS1 and an IS8. So it just gives you general principles and areas to focus on in terms of providing disclosures on sustainability. Right, so if we move on, so sustainability disclosures focus on 4 core areas. So there's a typo there. So it must be disclosures, not discourse. So there are 4 focus areas. Firstly, the governance of an organization regarding sustainability, the strategic approach a company takes, risk management, and then also metrics and targets. Okay. And for these, ISSB standards on sustainability, they have adopted the TCFD approach. So they used a lot of the recommendations from the TCFD for this, but they also incorporated some elements of the SASB, some elements of value reporting, etc., to get to a combined assurance sustainability standard. All right, so again, if you talk about governance, it's all about, how does the company ensure from the governance processes, controls, and procedures, how they would actually monitor and respond to sustainability risk and opportunities. And then also, if you look at the strategy, then it's about, how does these sustainability issues impact the business models, and again, linking it with the governance, how does the company's governance and structures align to ensure that they manage these risks and respond to these risks and tap into opportunities as part of the strategic planning, but also the financial planning of the organization. Then the risk management, again, focusing on how they identify the risk, how they prioritize the risk, how it actually relates to other elements of the business, not only sustainability point of view or climate related view, but also from a holistic point of view in the business as well. And then the metrics and targets is basically to provide information to investors to understand how the company measures, monitors, and manages the significant sustainability risks and opportunities. Okay, so for instance, CO2 emissions. So how do you compare with your CO2 emissions compared to global standards, and what are the minimum standards? Or and maybe in the future, and again, many people might think, oh, it's something that people are not looking at. But if you look at many asset managers and pension funds, and you look at Alan Gray, you look at 91, a lot of asset managers are focusing on ESG reporting, and this is a way of ensuring ESG reporting is, how would I say, consistent and convergent across different industries. So yeah, it is important, and it is something that asset managers are looking at when they're investing in certain companies, etc. So it's not something that's far removed from reality at this stage. Cool. So just to talk again about some principles. So a lot of the IS1 principles come through here. So they talk about fair presentation, which means that you need to go and have a look at a faithful representation of your risk and opportunity. So include all the relevant information, complete, reliable information, unbiased, all of that. also specifically information regarding your value chain. So if there's certain elements that impact your enterprise value, and how the value chain has been impacted across different elements of your business, you need to go and disclose information on that. And then also general features. So if you know IS1, they talk about general features there, and a lot of those general features also applies here, to ensure that there's comparable information, the frequency of reporting, the location of information, who is the reporting entity, and the financial statements, how financial data is used, as well as the assumptions used, sources of estimation uncertainty, like I said at the start of this presentation, errors, and also a statement of compliance. So a lot of general features and elements that you need to consider in this particular standard. And then the third one there is also talking about connected information. So it's not about providing information in silos. Some elements link to other elements that you need to go and disclose. So I'm just going to give a quick example of that. So if you have a company that has a production facility that generates high level of greenhouse gases, GHG, the company decides to close the facility. Okay, so what implications will there be? All right, so the disclosures that you need to make is to explain the financial consequences of that decision. So there might be a revised economic useful life for the affected asset. There might be impairment on it. It might also have an implication in terms of restructuring. So there might be restructuring liabilities coming through. What is the impact on the local community? And also in terms of reputation for the organization. So if you're closing down businesses or sites along the way, what reputation do you send out to the general public and communities regarding your social responsibility as well? So again, it's broader than just financial. It's also looking at other elements of your organization. Then so again, another example. So if you have a situation where a company supplier has recently found to have employment practices that fall short of international norms, the company decides to terminate the contract with that supplier. Okay. So again, what are the implications? So you could disclose that that the company is confident that its new supplier has employment practices that meets international norms. However, there could be a cost implication. So you could have a situation where now your inventory pricing might be different, and it could end up in a situation where your products might be more expensive in the future, or that you need to go and take some losses in terms of NRV adjustments. Right. Then the second one. So this is now the second standard that focuses on climate change specifically. So again, it is all about to assess the effect of climate change on the risk and opportunities on the enterprise value. And the standard, this specific standard follows a similar approach to the S1 standard and also the TCFD recommendations. So again, focusing on governance, strategy, risk management, and metrics and targets. If we go and move on to governance first. So again, it's about disclosures on the processes, controls, and procedures to manage climate-related risks. And it's all about the governing body, it can be the board, it can be subcommittees of the board. And again, it's important to disclose, what are the terms of reference? What is the mandate regarding the management of climate change? What skills and competencies does the board or the subcommittees have regarding climate change related issues? So it's becoming a very important element, because the governance of a company regarding climate change will steer the ship in terms of where and how they will manage climate change related issues. And very important, it's not, you're not going to look at the governance in isolation. You need to go integrate the disclosures and how the governance body is actually looking at strategies and the risk management of those disclosures on climate related risks. Then in terms of strategy, if you move over there, then they basically say it's like, okay, now you need to focus on how the climate change impacts the business model of the company. So think about the risk. How will climate change impact the business model? Are there changes that you need to make? And how do you go and strategize on these risks that you have? Okay. And then the standard talks about two types of risks. So you can have physical risk and you can also have transition risk. So the physical risks can be subclassified into acute risks and also chronic risks. So acute risks would be extreme weather patterns, for instance, or high drought seasons, or the extreme drought seasons. So again, if you're a farmer and you plant at a certain point in time of the year, but extreme weather patterns changes the way that you plant or how you would manage soil quality, etc., that's something that you'll need to take into account from a physical point of view and strategize regarding that. There can also be chronic risks such as rising sea levels, rising temperatures, and again, how that impacts your business and how you use resources is very important. And then you need to go and strategize regarding that. Transition risks. So transition risk is not the physical risk, so not the direct impact of climate change, but basically how laws and regulations are impacting how you would do business. So in this case, transition to low carbon economy. So for instance, there might be regulations coming in that say, okay, you need to lower your CO2 emissions, or you want to do business in a certain country, let's say France, and they say to you, no, if your CO2 emissions is more than this, we're not doing business with you. And therefore, you need to go and to understand those risks, such as the political, legal, environmental risks, and strategize on those risks as part of your business model to be able to still create value and to protect and enhance the enterprise value of your entity. Yeah. So Yapi just made a comment there. He said climate change and sustainability should also be taken into account when going concern is considered. Yes, it should. Going concern is just one element of sustainability. But yeah, obviously, if you're not a sustainable business in terms of climate change and broader sustainability, then you won't be a going concern either. All right. That's strategy. And again, if you have any questions, please ask me. I think maybe everybody just getting some awareness of this at least. So, but if you have any questions, please ask me. In terms of risk management, so again, it's all about the procedures and the processes and how the risks are actually managed. And again, important, it's integrated with overall risk management of the company. So it's not only looking at climate change. Yes, it's important, but you're looking at it in the context of the overall business. So, if you have a risk matrix, for instance, of a company, where does your climate change sit with your overall risk? What is your risk appetite regarding climate risk compared to all the other risks? And how do you prioritize this climate change risk over other risks in the company? Okay, and that's a very important thing. So it's about identifying it, assessing it, but also responding to the risk and linking it with the strategies on your business. Right. And then the fourth one is the metrics and targets. So now after you've done all of the strategic things, the risk management, it's important to go there then and say, how do we measure it and how do we meet targets? So how are we doing? And there are two specific components here that the standard talks about. They talk about the greenhouse gas emissions. And there they talk about, the scope 1, 2, and 3 disclosure in terms of metric tons of CO2 emissions. So you need to provide information regarding that using greenhouse gas protocols. So, I am not an expert on that, so I will need to go read up on what it is. But you need to use the protocols of measuring that. So there are obviously certain criteria and standards that you need to meet. And an interesting implication is that if you have an associate or a JV you need to have separate disclosure on that because you're not consolidating that fully into your business. So you need to show that separately. And then lastly, you also need to go and talk about the impact on the value chain. So you need to go and say, the impact on the greenhouse gases, if certain suppliers or certain contractors have high greenhouse gases, how do you manage that? How does it impact your value chain at the end of the day? Okay. Then industry-related disclosures. And this is very interesting because now this is where the SASB disclosures are very important, as well as the CDSB disclosures, because they are renowned for having very industry-specific standards that provides guidance to specific industries. So in this standard, they actually have industry-based standards as part of an appendix. So very important that you need to go and link that to your business model and link to the impact on your business model. All right, and they provide basically 77 different industry classifications across 11 sectors. So there's very specific industry measures. Maybe for the restaurant industry or the food industry, how are you ethically sourcing food or meat or plants for your business, for instance, just ethical farming, free range, all of that. That's maybe a very simplistic way of looking at it, but how are you managing that? How are you managing water consumption? Is there a more effective way of feeding the world at the end of the day? So all of those elements that you need to go and consider. Right. So just an example here on disclosures. I see there's a couple of questions or comments coming through, and I'll address it now. So there's a disclosure here. So basically, a company that is in the automobiles industry might review requirements and determine that the disclosure topic, fuel economy and use phase emissions, is relevant to its circumstances. Okay. Then I say the disclosure topic notes that more stringent emission standards and changing consumer demands are driving the expansion of the markets for electric vehicles and hybrids, as well as for conventional vehicles with high fuel efficiency. Okay, so for instance, if you have a Toyota Land Cruiser, you're working on diesel, what is the, you need to go and assess what is the relevance of that particular car going forward with the new technologies coming through, etc. I mean, obviously, South Africa loves their Land Cruisers, but maybe in 10 years' time, it might be obsolete. So, in terms of the disclosure, you need to go and talk about the transition risk. So, if the company needs to mitigate the risk of changing buyer preferences and adapt to the business model, so you need to go and say that, how is the company going to respond to this? So how are they going to ensure that, either this car is still relevant, or how are they going to transition into a new business model with new electric cars and hybrids coming into the market? Then the second one could be that also climate-related opportunities. So if a company innovates to meet or exceed regulatory standards and capture an increasing share of the evolving market. So maybe, there's an opportunity here to move into a market and capitalize to this opportunity. So, that's a type of disclosure that you need to go and have a look at. And obviously, I'm not an expert on it. I'm also learning as I'm going here. But it's just something that's very, very interesting and something that I'm quite passionate about. So, so there's another disclosure here also. So again, on the automobile industry, so if you have a situation where there are certain climate-related targets, how would you disclose that information? So again, if you're looking at automotive companies, if they have established an emission reduction target, it's important then to go and say, how will they actually make progress towards that target? Okay, and is that target something that is globally accepted? And again, that's where the standards are coming in. So if everybody's using the same standards, then you will be able to understand, is this company providing, are they making a change towards climate change, or are they only greenwashing, and again, maybe that's another question, is that how will this be assured by auditors going forward? That's another question. So, but it's becoming a very, very hot topic. But anyway, so they need to go and provide information on fuel economy and use phase emissions on that particular disclosure topic, which is an industry-related topic. And then they need to provide information on the fuel economy of the company's fleet, and also sales on zero-emission vehicles. All right, so that's just an example of what is happening. So if you're an automotive company, you've got certain industry-specific standards, and disclosure that you need to go and use for your sustainability on climate change. All right, and I think that is it. So I'm done for with the actual presentation. And again, if there are any questions, please feel free to ask. So I'm going to go through a couple of the questions that has been asked. Eunice Lara is asking, to which companies will this apply? Okay, so that's a very good question. And at this stage, it's all about regulation. So at this stage, it's completely voluntary. So once they issue it, if you're a company that you think you will find benefit from it, you might get access to funding from banks. Again, banks are also under pressure to improve their exposure to climate change and green practices and stuff like that. So if you're a green company and you want to show to banks that you are doing things, you are considering the environment, you are considering climate change, and you can voluntarily go and adopt this, then yes, sure, you can do that. In terms of to which companies it will apply, in South Africa, we will need to wait and see. I think the JSE will make it part of their listing requirements. That's my view. So once this will be issued, I think the JSE will say, that will be a new listing requirement that you need to take into account. I can't speak on behalf of the JSE though, but if you see how important it is for the JSE, that I think they will go and adopt this. All right. So, and again, if you have any other questions, also please shoot. So there's a comment here also, generally this climate change and sustainability issues are actually an expansion of the disclosure of the 3 Cs. Yeah, it is. So yeah, it's a triple bottom line, and it has evolved over a number of years. As we've been talking about sustainability, if you look at academic research, sustainability has been something that's been talking about since the 1960s, 1970s. So I think the nature of the issues that you have has evolved significantly since then. And if you think about integrated reporting, there they talk about the 6 capitals. So your financial capital, your manufactured capital, your intellectual, your human, social capital, and your natural capital. So that has also evolved. So they don't talk about the 6 capitals here, but you can have that type of thinking in terms of which aspects of your business is affected and how you are effectively managing that. So yeah, it is an expansion of something that has happened previously, but obviously things evolve, and some things are more critical than others in certain jurisdictions. So for instance, South Africa, yes, climate change is a big issue, but we also have a lot of social issues in South Africa, social economic issues, to ensure that poverty gets reduced, that the unemployment rates are lowered, all of those elements also, and South Africa has got a unique and complex challenge, which stretches far beyond only climate change. So that's why sustainability is so important. Okay, I don't see any other questions coming through. But if there are any questions, maybe something that you want to find out that I can research for you, feel free to ask Stan or Danny to email me, and then we'll take it from there. But thank you for being here, and I hope you've enjoyed it.
Interesting afternoon. And to those of you, thank you to those of you attending. I'm sure you enjoyed very slick presentation and to the point, and your certificates will be on their way. I think some of you will have already, most of you will have already received certificates from yesterday. Watch the space for future Zoom sessions, which will be coming up during the rest of the year. And well, you've got an extra half an hour to have that extra cup of coffee, or to make it an early night, or whatever you want, before load shedding kicks in at 5 o'clock. And thank you again. Thank you, Danny. Thank you, Milan.
Thank you,
Milan.
Milan.
Thank you, everybody. Take care.